A very hearty good afternoon to one and all present here. Today, I, Nidhi Srivastav, will be hosting the fifth episode of Startup Odyssey. Before diving into today's session, I'd like to thank everyone who are with us now, and also to those who couldn't join us today. On behalf of ESEL, we are delighted to welcome you to the fifth episode of Startup Odyssey. So, we all know that to establish a startup, money is the greatest necessity. Ever wondered how any startup gets funded or who invests in it? You all might have come across words like seed funding, angel investors, venture capital, and many more words which often blow our mind. So, to get a better understanding of all these things, we have with us Mr. Pranav Pai, who would enlighten us about how to get funding for your startup. He is a founding partner and chief investment officer at 314 Capital, an early stage venture capital fund based in Bangalore, India. He also serves on the boards of and is an advisor to several companies he works most closely with. Some of the investments made include Licious, BetterPlace, Drawinbox, and many more. So, without wasting much of your time, I invite Mr. Pranav Pai to throw some light on how to get funding for your startup.
Thank you, Nidhi. Hi, everyone. It's great to be here. I'm a big fan of the IITs in general. So, first of all, I'm very happy to see more entrepreneurship at the IITs. I am presenting my slides for today's session. We have roughly an hour. So, what we have decided to do is have the presentation for between 40 and 45 minutes. And of course, if time permits towards the end, I'd be very happy to answer as many questions as possible. I just have one note on the presentation. I like typically for any startup, we have more slides to present than we have time for. So I hope you'll permit me to go through the slides faster. I promise you, it is more important that you listen, you absorb, then you read everything on the slides. Don't worry about coverage on each slide. It's more important you get the core message than anything else. So without any more delays, again, thanks for having me here. Let's go. So guys, what's happened over the last just 18 months and something very interesting across the world has happened at the same time. COVID has been like the acid test that put every fund manager, every portfolio, every asset class, every country in the world through a test at the same time. It's very rare we have events like these, and these are therefore, and very realistically, that's why they are called generational events. What COVID-19 has done is it has exposed almost every industry in the world, from energy to food to technology to communications. Any mainstream industry has been fully exposed, and they've been made to see the stark reality of the many chasms in their assumptions. And one very clear winner has come out of this. The very clear, obviously, winning point is that technology-driven resilience has become the most reliable, future-ready mode to own. And obviously, as you guys will remember, this time last year, the whole world was in complete turmoil. The media was writing obituaries about this industry is gone and airlines will never come back and startups are dead and all kind of negativity. As always, the media is a little bit too quick to jump to conclusions. But if you look at the data, what is very clear is that there has been significant erosion of capital in terms of how quickly all the markets fell in value. So you guys all remember the Indian markets fell. I'm sure many of you do stock trading on Zerodha and so on. So all of you would have seen, if not first, at least a second order view of just what kind of erosion happened. Now, obviously, we are in hindsight, we know what happened after that. But one very important response is that every single central bank in the world printed money like it has never printed before. It is unbelievable the degree to which governments across the world have thrown all macroeconomic theory out of the window and said, this is something that we will not be able to ever forgive ourselves if we don't deal it face up, head on correctly. And the wave of stimulus programs across the world, we have never seen before. India, as you know, historically has been a very selfish country in terms of printing money, giving subsidies to the general population. India gives large subsidies to what it calls the marginal impoverished communities, farmers and so on and so forth. But even India had to print large amounts of money, borrow huge amounts of money, announce industry-wide stimulus just to make sure we protected lives, protected livelihoods. So it's been an unimaginably difficult and interesting experience what the world has gone through over the last 12 months. As a result, of course, you saw even in the stock markets, this is just one example, but entire legacy industries collapsed. This is an interesting graph. It's one example. All the US airlines crashed 70 to 55% in value. But Zoom stock just in 3 months grew 129%. All of you, of course, know Zoom. It's very similar to AirMeet. And at one point in time, Zoom was going to be the substitute for business travel. And therefore, the embedded value of Zoom just kept on growing exponentially. And of course, Zoom is not the only winner. In general, tech-first monopolies have benefited enormously from COVID. Today, the world's most valuable companies are not oil companies, not banks, not insurance companies, not transportation companies, not airlines. All of the world's large cap, mega cap, trillion-dollar companies are now tech. And unfortunately, for the rest of the industrial environment, we have seen a K-shaped recovery. This is the worst shaped recovery possible because it means some industries pull out and become enormous winners. You can see your tech, retail, software services. And some industries need a lot of assistance. They are not showing any signs of recovery. Travel, entertainment, hospitality, obviously, you guys know the list. And this is the environment in which we come to Indian startups. As you all know, India is now the third largest startup ecosystem in the world in terms of size, in terms of number of startups, in terms of number of unicorns, in terms of amount of money coming in. India is only third behind US and China. I'm very happy to say, and all of us should be proud, that in 10 years, we've beaten France, we've beaten Germany, we've beaten UK, we've beaten Japan, we've beaten Singapore, we've beaten Israel, we've beaten all these countries that typically have a claim to being in the top 5, and we are now firmly in number 3. And in this decade, and in fact, if you just look at 2014 to 2020, just take the 6-year cycle, our startups have raised $70 billion US. $70 billion US is more money than has come into most markets across Asia in the same point in time. We now have over 500 institutional investors, large funds who are investing actively, 2,000 active investors, small funds, angels, and increasingly now in India, you will see that 67% of all the startups are concentrating in Delhi, Mumbai, and Bangalore. Just Bangalore saw 45% of all the money coming between 2017 and 2020. And if you thought last year was a bad year in general, look at this. Startups still raised $11.5 billion in 2020, in spite of being COVID and the debt of the world and all of that. Obviously, the hype and drama the media was talking about. And what has happened, because so much money has been printed, so much of a shift has happened from old companies to new tech companies, from legacy to startups. Just in 5-6 months of 2021, from Jan to today, 15 startups have become unicorns. 15 startups have become unicorns in half a year. Just remember, when we started 314 in 2016, there were 12 unicorns in India. So in 1 year, we have made more than what India made across more than half a decade, last decade. And all of these companies, if we look at them, they're in almost every sector. It's not like one sector is benefiting only at tech, only this one, only that one. Across sectors, India is minting unicorns, creating large companies that are enormous value creators for their employees, for their founders, of course, for their investors. So today, I'm very happy to share, like I said, we are number 3. We have 55 unicorns in India today. These are all the sectors they're in: e-commerce, fintech, enterprise. This is the geographical distribution. Bangalore, of course, continues to lead in terms of unicorn concentration as well. And of course, we're nowhere close to stopping. We have 51 soonicorns, soon to be unicorns. So again, fintech, consumer services, health tech, and of course, again, Bangalore leads from a geography perspective. But the unicorn wave is not stopping. In fact, it's only going to accelerate. And India's 55 unicorns have created $150 billion of value. No one in their right minds, even 5 years back, was predicting that so much value will be created by such few companies so quickly. It's unbelievable. And all of us, whether we are in the startup ecosystem or not, whether we think making money is good or not, these are large value creators. They were going to go IPO. They're going to allow retail investors to invest. Many of them will fail. Many of them will not succeed. But so many jobs, so much talent, so much encouraging investment into India's next generation. It's important because if this was not happening, as always, India would lose its best people every year to the rest of the world. So this is a fantastic achievement for the economy, not just from a wealth creation perspective, but for jobs, for culture, for self-determination, for self-resilience, for many, many reasons. It's very important that India was able to support this kind of innovation over the last 10 to 15 years. And we mentioned India as number 3. And let's be very clear now, everyone. If you're a global citizen out of India today, you have an Indian passport, I'm sure all of you will get the chance to travel the rest of the world. Many of you may relocate. That's fine. Just remember in the back of your mind that now India is no longer that tin pot economy that your parents grew up in. We had a horrible first 50 years, socialism, Marxism, all kind of ridiculous economic theories, 5-year plannings. Of course, we got some good things like IITs, but over a 50-year period, India just did not invest in the prosperity of its own people. And we were slaves to an economic paradigm that never considered wealth creation and the prosperity of its citizens as the ultimate goal. It considered control, regulation, very tight boundary conditions as a reason the government should exist. So that transformation from a boundary condition-led economy to a prosperity-led economy, that is the wave that we have all been beneficiaries of. And it's very important that at our generation, we continue that. And that's why now, recognizing who we are competing with, we're not just competing with ourselves. Of course, a lot of transformation has to happen inside India. Yes, we have lots of problems to fix, but we are also competing now with the rest of the world very clearly. And if you go to the US, you go to China, they're very aware. India is number 3, and we have to be aware. We're not competing with these small countries in Asia anymore. It's US and China. We have only 2 large-scale competitors, and we have to be very focused that this is competition. It's very important. And of course, startups are not the only ones that have benefited. Our largest companies, I'm just using Jio as an example, but Jio set the markets on fire last year, $15 billion. $15 billion raised in 3 months. India has never seen this kind of capital accumulation before. Unbelievable transformation. Many of you may be skeptics, that's fine. No one's expected to believe the full story, that's fine. But now Jio is not the only one. This year has been the year of Tata. You would have seen the acquisitions, the roll-ups, the investments. You very soon see Mahindra, you see Bajaj, you see all of India's large conglomerates now investing large amounts of money. They've never invested before in their own transformation because they've all realized if we don't transform, we are dead. And of course, it's not just startups and companies that have benefited. All of that liquidity, that excess money that was printed is all now coming into the markets, and every fund in India has raised record-setting amounts of money for their next fund. Sequoia, Lightspeed, of course, 314. We are closing our 5th fund in 5 years. So we've also been very aggressive in terms of raising capital. You see more and more capital is now sitting on the sidelines waiting to invest in India's next big generational companies. And finally, of course, the good news is that India's markets are now very much in demand globally. The world's biggest investors, Silver Lake, Tiger, SoftBank, a dozen large firms like TPG, Warburg Pincus, every one of them is now actively investing in India, and they're all doing one thing, unicorn hunting. Everyone wants to be a part of the next wave of large companies being built in India. And like I said, just this year, almost every 2 weeks is a new unicorn in India. We have 15 so far. I wouldn't be surprised if we added at least 10 more in the second half of the year. So is this all accidental? Is this all people are just getting lucky? They're throwing dice and making bets and winning? Not really. The answer is very simple. This is actually a very carefully designed, year by year, incremental change driven achievement. And we have to all, of course, we are better prepared for the future if we understand the history of how we got here in the first place. So over the last 10 years, if you study the unicorn dynamic, these are a sample size of the unicorns that we measured. On average, it takes 7 years for a company to become a unicorn. On average, they raise 9.9 rounds from starting up, the very first angel round, whatever you call it, to becoming $1 billion in valuation. And on average, they've all raised $120 million a year. So it is not a 0 to 1 kind of outcome like you see in the movies and you see in TV shows. It is a steady grind of continuously accumulating growth, accumulating metrics, building value, convincing investors. So it's very important that you understand that the last wave of companies that became unicorns, step by step, every year, they had to really go through the grid to get there. And of course, if you consider these 55 companies as outliers, because there are 50,000 startups in India and 55 are unicorns. So the attrition of value, attrition of selection is very steep. It is a wholly non-linear filter. If you guys know, of course, all of you engineers. So the pass filter of how unicorns are created is extremely rigorous, and it's obviously very, very highly non-linear. What you are seeing is the elemental characteristics of these companies. You have exceptional people as founders. These are not regular people. They don't think regularly. They are betting on very vastly innovative ideas. And very importantly, they have understood that money, capital on your balance sheet is a moat. It is a strength. And how to raise money, how to keep money going, how to of course preserve credibility with investors, and how to make sure you never run into a no cash scenario. That is one of their most horizontal, most elementary strengths. And of course, once you have capital, you can invest in people, you can buy other companies, you can build technology, you can invest in R&D, file patents. Capital is the moat that allows you to be an even more powerful influence on your market as a unicorn. And of course, while they are raising money, they are also growing revenues enormously. Just for these 8 to 10 companies, you will see from their average year-on-year growth, the multiple. Baiju, for example, is more than doubling revenue every year. ShareChat is growing 8.5 times revenue every year. And Udaan is growing 6 times every year. So the rate at which these companies are growing revenues, that is why they become unicorns in 7 years. It's because they have figured out where to invest to get that growth. And in the end, all that capital coming in is chasing that very growth. And finally, of course, now our startups have become large acquirers themselves. Flipkart has bought a dozen companies. Freshworks has bought a dozen companies. Baiju, as you guys saw last year, it was in the headlines every month, buying a large company. Now these companies are buying other large companies. And today, you might have seen the news, PharmEasy bought Thyrocare. Thyrocare was a listed company. Now startups are buying listed companies in India, which is tremendous. Usually listed companies buy startups, as you guys are familiar with. So the scale to which our startups have reached now at the very highest levels globally. And this is a significant achievement when it comes to how they use capital. And of course, now all of these companies are looking for the next big wave of talent. They're all aggressively hiring. I'm sure your placement at IIT has become more and more dominated by startups every year. You guys know, you are feeling the opportunity every day. It's very clear that the kind of investments happening in talent today, there is a full arms race with all these companies trying to hire the best possible people they can. And now companies like Baiju is amongst the most valuable startups in India, if not the world, now has over 23,000 employees doing what they're doing every day. And of course, all this, again, like I said, didn't happen automatically. For 20 years before startups became a thing in India, IT companies like Infosys, Wipro, HCL have consistently been training lakhs and lakhs of people every year in how to write software, how to deliver code globally, how to work with global clients, how to generate revenues outside India. And I'm very happy to say this is the foundation. 20 years of the work they have done is the foundation on top of which startups have built so that they can scale even faster. So if IT companies took 20 years to become multi-billion-dollar companies, startups are taking 7 years, 8 years to get there. And that is a tremendous acceleration of the value creation in India. And finally, of course, I don't need to tell you why I've told you why fundraising is important. I don't need to tell you that all of our companies are raising money like they've never seen before. Baiju's valuation has grown almost 400 times since 2015 to 2021. And all these companies, look at these multiples, absurd multiples. Swiggy's grown 800 times in valuation. If you guys had the opportunity to invest or start even one of these companies, you would have been almost a billionaire in the time it took you from getting to 8th standard to graduating IIT. So if you do this right, the lesson here is if we do this right, if we build companies correctly, if we invest correctly and we approach the game with a level mind and a clear focus, the value we can create, there are no barriers to it. So now that we've seen the historical context, now that we've seen what the environment around us has become, and of course the context to the liquidity that we are enjoying today, let's look at what you guys should be facing, what you guys should be preparing for in the early stage. So I have 5 things to talk to you about today. And one caveat I want to add is I am not going to teach you every single detail of what you need to know, because you guys have an advantage I didn't have when I was starting out. I was starting out in 2011. So I've been doing this for just over 10 years. When I was starting out, very few unicorn was not even a word, very few blogs, almost no videos on YouTube about what entrepreneurship is, how to build, how to write code. But over the last 10 years, almost all the knowledge from startups, founders, podcasts, everything is available online, right? So you should know, and you guys are the smartest engineers in the country, you know for sure that you don't need someone to come and teach you point by point. Your skill is that you will learn quickly. So my goal today is to direct you to what to learn, where to focus on, and what are the fundamental elementary principles you should keep in mind when you are approaching a fundraise, if you're an entrepreneur, if you're a startup employee, some of the most basic things you should know and always hold as true. So let's start with some of the eternal truths. If you're raising venture capital, you have only one thing to prove, that you will grow very, very rapidly. Of course, there's nothing wrong with building a business that doesn't grow this quickly. Nothing wrong at all. You can start a restaurant, you can start a food delivery business that doesn't grow like Swiggy, that's completely fine. But if you want to be a startup, you want to raise venture capital, you are indirectly, subconsciously, consciously, whatever you want to say, the social contract you are signing up for is that you are committing to high levels of growth. And if you don't have growth, you will not succeed. You are not a startup. You will not raise the large dollars to continue your growth trajectory. So it's very important that you know that there is no going around, no negotiating with the fact that you are meant to deliver growth. And of course, another very important truth is that you have to be ready to pitch anytime. You are always fundraising, you are always selling, you are always recruiting, you are always competing with other startups. You will never have a day's peace where you say, okay, today I don't have to sell anything. I don't have to talk to anyone. I don't have to pitch anything. You are pitching every day. This is also, you should know, every year is getting deeper and deeper in terms of difficulty, but venture capital and startups are a very performance biased ecosystem. And this is amongst the most competitive environments you will face. Now, all of your IITians, you are winners. You are the best 10,000 students of your year. What you've done is tremendous. Now, I'm an engineer also. I know exactly how hard it is to get in. But if you thought that race was difficult, look at the ratio of success in startups. We'll show you some numbers. It is one order of magnitude below what you are typically used to in your educational environment. So the competition is only going to get harder from here. If you are the top 10,000 of India, once you graduate, you are competing with the top 10,000 of every year for the last 30 years before you. And not just in India, you're competing with the top 10,000 of China, Japan, Singapore, Israel, US, UK, France, Germany. You are competing with the top 10,000 of 30 years all over the world. So be prepared that you will have to be at your A game 24/7, at your very best. And if you're not there, you will lose. And of course, everything is under judgment. Who you are, your degree, your founding team, where you come from, your accent, the shirt you're wearing. Unfortunately, we are all human beings. No matter what a blog tells you about be your best version, so on and so forth, it's not true. Everything about you is under judgment 24/7. And if it's not investors judging you, it's your employees. If it's not your employees, it's your co-founders. If it's not your co-founders, it's the other founders competing with you. Every day you will be judged. And that is important because in terms of mental resilience, the pressure that you are under when you are a startup founder particularly, it is unlike pressure you will face anywhere else. Another very important truth, guys, is that as much as the growth, the numbers, the metrics matter, if you're not able to deliver the narrative in a way that makes people believe what you're saying and believe the projections that you are giving about your company's future, it is very unlikely you will succeed. So the narrative is as important as the numbers. Another very important thing is, this as engineers is one of the most important logical stumbling blocks we run into, is that the entire reality of startups is ridden with a minefield of tautologies. A tautology is basically a self-proving statement. The sun is going to rise in the east because the sun rises in the east. It's a self-proving statement. It's a tautology. And I'll give you a very interesting tautology that startup founders face every day. Now, in the media, as you read about startups and your seniors raising companies and so on, they would have used this term, a hot deal, hot area hai, right? It's a hot area. E-commerce is hot right now, or payments is hot right now, or fintech is hot right now, or edtech is hot right now. Last year, for example, edtech was really hot. Almost every large company raised hundreds of millions of dollars, right? Now, there's a tautology in this situation of a hot area, because unless large amounts of money comes in, it's not hot. But unless it's hot, large amounts of money is not going to come in. So there's a self-proving contradiction here. What is hot? Why it's hot? How does it get hot? The whole thing is a tautology. But that's reality. Reality doesn't change because you and I wish it changes. That is reality. So be comfortable with tautologies. Identify them, embrace the uncertainty in them, and use everything you have, all the ammunition at your disposal to cut through that uncertainty. Because in the end, no one's going to help you through it. No one's going to feel sorry for you if you think it's not fair. The tautology is reality. Get used to it. And of course, because things change so fast, definitions are constantly evolving. What was an acceptable revenue number to raise a Series A in 2019 is no longer an acceptable revenue number in 2021. So the definition of a Series A also has changed. When I was starting out, a Series A was $2 million in India. Today, I'm writing checks for $10 million Series A's. Unbelievable growth, but that's the inflation in the environment. Very important. Once you raise money, these investors join your cap table, as you know. Your cap table has to become a moat. It has to be an advantage you have. Very often, most founders, after a couple of years, are unhappy with the people on their cap table, their investors. They don't like them. They're not contributing. They're holding me back. They're constantly doubting me. They're questioning me. So be very, very careful and sensitive to whose money you are taking. And that's why your cap table has to be thought of as another moat you're building for your company. And of course, the last truth, if you're starting out, is that your last raise is never going to be your last raise. You will always be raising. And of course, we'll talk about that as we go through the slides. So I spent a little bit more time here, but I will be going through many examples and showing you how these truths are realized in the actual environment. So very quickly, what does the capital chain look like? When you're starting out, typically you are told, okay, there's a seed round, then there's some early stage rounds, there's a mid stage round, then you have later stage round. This is the entire venture capital spectrum. And then you go into the corporate finance, growth stage, buyouts, mezzanine, restructuring, before you go IPO. So typically, you would have a small accelerator type thing, like 100x, then you would have a fund like 314, then Sequoia, then Tiger Global, then the TPG, Warburg Pincus, all these guys, BlackRock, before you go IPO. Right? So for example, Baiju. Baiju came to us in our previous fund in RN, then went to Sequoia, then went to Tiger, then went to TPG, then went to GA, then went to Warburg. No, Warburg is not there, but from GA went to BlackRock, and then now preparing for an IPO. Today, unfortunately, what I will tell you is this is no longer true. Tiger Global is doing seed rounds. Sequoia has an accelerator program. 314 is doing mid-stage. BlackRock is writing late-stage rounds. General Atlantic is doing mid-stage. There's been a full inversion of capital. Every fund is doing whatever it can to find the best company and just invest. So the competition on the investor side also is intensifying exponentially every year. So while you think there's a nice clean spread, I'm sorry to say that is not true. That has never been true actually. But even if it was true 3 years back, it is definitely no longer true in 2021. And what is reality is that, in a sense, before you raise large money, you will be going through this valley of uncertainty. Most startups die here in the early stage. But once you break out, it's going to be very clear you will be raising multiple rounds. And your valuation will grow very, very steeply if you're doing it right as you get to your IPO. So be prepared for an absurdly non-linear journey. It's not going to be linear piecewise as you scale your company out. Next, there's an important thing that you should internalize. And in India, we call it Swadhyaya, or the eternal truth of knowing yourself, conquer yourself first. Now, this is a very popular story. Most of you would have heard it. But when Alexander got to the Indus and he was about to enter India, and you guys know he was fighting with Porus and so on, Purushottam, as we called him in India. On one of those days when he was figuring out what to do next and should he continue into India, he met an old sage outside a temple, and he went to the sage and asked them, "Sage, tell me a truth. Will I conquer the world?" The sage only looked at him, laughed, and said, "Oh, Alexander, conquer yourself." That's an important lesson. It's a little dramatic, but it's an important lesson because until a startup, a team, a founder individually has mastered their domain, has figured out exactly what we'll be doing, how we'll grow, where is my business model, where are my customers, how much will they pay, what is my margin, where do I need to invest, what are my costs, what are my competition's pricing, where are their margins, what are my opportunities when I attack them. Unless you know the answers to all of these things yourself, you are going to find it almost impossible to convince other people, especially investors. So master your business model. And of course, mastery doesn't come just because you studied it from someone's blog. You have to be able to have real domain expertise, real experience on the ground before you build true mastery. So it's very important that all of us young people, as students, and that was true for us also while we were graduating from our master's program. We were sold this myth that you graduate, you start a company, you'll be a hit. You're young, you'll figure it out. Unfortunately, that's not really that's not a real story. That's the outlier story. What you saw in the movie about Facebook is the outlier story. For every Facebook, there are over 100,000 or lakh other startups that started that way and failed miserably. So it's very important that you guys figure out, if you're starting a company, when should I start it? Do I have the mastery to start it now? Or should I work for a startup? Should I work for a company? Should I build expertise? Should I build mastery before I bet my entire life on starting a company? Because once you start a company, like I told you, there's no way that you are going to be allowed to be on your B game. You have to be on your A game 24/7. So master your business model, conquer that before you go out there and try to conquer a market. And demonstrate, if you've started your company, you started building it out already, be able to demonstrate very tangibly how your primary metrics are tracking in the right direction. We will talk about this in more detail, but unless you can show that your numbers are growing a certain way, and unless you can build credibility that your numbers will continue to grow a certain way in your projections and guidance, you will not be able to convince anyone. Forget investors, not even employees, to join your startup. Very important, if you are a founder, you're starting a company, train yourself to think like a shareholder. You are not an employee of the investors. You are not an employee to your board. You are not someone who answers to your angel investors. You are, as a founder, the biggest shareholder in your own company. It's very important you should know, Byju, for example, is still 45% of the cap table. If Byju as a company is worth $16 billion today, Byju Ravindran is worth 45% of that, close to $7 billion. His shares are worth that much because as a founder, he realized, I am the largest shareholder. Right? And we had the privilege, like I said, to be able to invest in Byju in the first round from our previous fund. But that kind of founder, that kind of mentality, I can assure you, that is one of the most important strengths you will have when you're starting your company, to train and think of yourself as a shareholder. Of course, as a founder, you have to build a company. You're the CEO, CTO, CPO, whatever you are, but you're also a shareholder. Never forget that. When you're going out to raise, this is very important. Before you raise any money, start planning around, know exactly why you're raising. Investors are not going to invest in a company to pay your salary, to pay your friend's salary, to pay your employee's salary. They are going to invest with a very clear view that you will take the money and grow the value of the company towards the next milestone. They are investing to multiply their money, not to pay your bills. So it's very important you know that when you're raising money, I am raising money for very specific value or creative outcomes. I will grow revenue. I will improve margins. I will build IP. I will get new customers. I will invest in a sales team. That is the definitional answer of why you raise. And that's why good investors will invest. So be able to answer the question of exactly why you're raising. I'm running out of money tomorrow. I can't pay the rent next month. That is not a good answer to why you're raising a equity round today. Very importantly also, to know yourself is to understand the perception of your market, your business, your sector at this point in time. Every sector, like I said, every month, every week, what is hot, what is not hot is constantly changing. It's very important for you to know and mind the perception of your environment so that you're constantly aware. Is my sector hot right now? Is it not hot right now? Why is it hot? Who else is raising? You have to be hyper aware about the situational environment around you. Last two things, be very honest. No, let's be clear. Startups are not a guaranteed success. In fact, probabilistically, startups are the worst bet you can make. It's a riskiest asset class. And it is an all or nothing outcome almost all of the time. Be honest with yourself, because if you are self-delusional, if you do not understand reality, and if you start lying, whether intentionally or unintentionally, if you start lying and you build a reputation of someone who does not speak the truth, you will almost never be able to repair the reputational damage or counter the reputational risk that you are building of yourself and your company. So you guys know the stories of housing.com and so on. You read the history. Many of you would have been in school and college and you would have seen that story playing out. You don't realize how much of that was unnecessary, ego driven and so on and so forth. I don't want to pick on one company, but I'm telling you, even at the highest levels, the lack of honesty, the deterioration of credibility, and then the breakaway of trust, that is something that if you don't control actively from day one, almost always becomes a huge problem as you scale. And finally, of course, keep this in mind. If between you guys, the founding team, the founders, the early employees, your team, the people in the startup, if there are disgruntlements, disagreements, if you guys are not aligned before you go to the market, investors, other people will immediately recognize the faults, the fault lines in your company. So if you are all not aligned, if you are disgruntled, if there are disagreements, sort it out. Don't go to market before. And this is a very important part of knowing yourself, because if all of you are not comfortable doing what you're doing, it's unlikely you will win the confidence of someone else. And that is always very important to know before you hit the market. So, of course, I don't want to spend too much time on many of the other things. Let's talk about some examples. So we spoke about self-awareness in the early stage. I told you none of this is going to be linear. Before you get to the seed stage, the first institutional round, you will have angel rounds and your incubator, all the IITs have an incubator now. You'll probably get some money, grants, so on and so forth. This is where you will do all your exploration and figure out product market fit. This is what you need to do before you go out there to raise institutional money. Because remember, when you go out there, every investor you meet, every fund you meet, large fund, small fund, American fund, Indian fund, whatever fund you meet, the first impression you leave with them is going to carry with them for the rest of your career. And if you're not ready, you're uncertain, you've not finished your self-learning, your confidence in your own idea and your vision, that is going to be a big, big fault line. It will very clearly expose you in your first impression. So be very careful that if there's uncertainty, sort it out before you go to the market. And when you're here, it's very clear you have fewer uncertainties. You're building very clearly towards product market fit and becoming a predictable business model. And when you hit predictability, it could be seed, it could be Series A, it could be Series B, wherever. This, like I said, this is no longer true, but that's when everyone will want to invest in hypergrowth. Don't try to grow in a non-linear way here. It's pointless. Don't try to do your drunken walk, you're figuring out yourself here. It's pointless. Because then you're losing confidence from your investors. So be very clear how you sequence the different stages of your company. And when you invest in growth, you have to be able to grow once you're confident you have the right model. Now, we look at many different surveys across hundreds of companies, US, Israel, UK, India. As investors, we constantly ask other investors who came before us, why do your companies fail? We asked one very prominent angel group in the US. They had invested in 200 companies over 5 years, SV Angel. And this is the survey result. For them, 42% of their companies failed because the timing was wrong. Meaning they were too early or too late, there was too much competition, whatever it was. 32% companies failed because the team could not work with each other or they could not execute. The third reason they failed is because their idea was not as far ahead or as true and elementally brilliant as it should have been. It was a very boring idea, for lack of a better word. Fourth reason is the business model was wrong. The assumptions were wrong, the margins were wrong, the customers did not want what you were pitching. So there was fundamental lack of clarity in the business model. The fifth reason is funding. Now, most of us would have thought funding would have been at least number 2, if not number 1. But the answer is very simple. If you don't figure out these things, you're not going to get the money anyway. And even if you raise the money, if you don't figure out these things, you have a very low likelihood of success. So it's very important you know that to sequence in your mind the role money plays and when it comes in. And that's why team, execution, the idea, the business model, knowing yourself, knowing your sector, knowing your space is more important than just raising money. Because if you figure all that out, I can assure you a lot of money is waiting to invest in high quality companies. And finally, do investors know what they're looking for? It's a good question. Because if I am telling you know yourself, you, as founders, you should ask, do these investors know themselves? The short answer is every investor thinks differently. This is a list, for example, of what SV Angel, the same that angel group, looks for in an early stage company. Look at this list. Do you see anything coherent, conducive here that makes for a determinant parameter in growth? The answer is no. These are all very basic common sense things. Nothing here is an insight, such a radical insight that you wouldn't have figured it out yourself if you're 20 years old. So the truth is, no investor has a hidden golden nugget of wisdom to give you that will change your world. It's going to come from you. And it's very important for you to understand that all investors have their heuristics and their rule thinking and so on and so forth. But growth, performance, clarity, very simply the quality of execution, no matter who you're talking to, if those things are true, you will always be able to raise money. Another very important truth, sorry, the numbering is wrong, but I mentioned stories before, but no one better than Steve Jobs to tell us that the most powerful person in the world is a storyteller, right? But of course, if you don't have the story built on top of hardcore metrics, you're not going to be a successful company. So the marriage of the narrative and the tangible proof, that is the combination that is going to be your bedrock if you want to be a billion-dollar company. And of course, when you have to know yourself, you have to know your metrics, you have to know your industry, you have to know the actual definitions of what is this metric, what is that metric, what's the difference between LTV and ACV and Dow and Mao. Thankfully, you guys, like I said, are starting out in 2021, where all of these things are clearly, openly defined. Blogs and blogs and blogs have been written. Textbooks are available for startups now in MBA colleges, which is crazy, but fine. You can buy books for free. Now, podcasts. Everyone is a startup guru today. Of course, a lot of noise, but thankfully, a lot of access. So you have no reason why you cannot figure out the metrics that are important to you. You don't need an investor or a coach to tell you what metrics are important. Everything is a Google search away. And finally, Swadhyatma is important because, like I said before, you are in a brutally competitive environment. And let's be very clear, in funded startups in India, only 30% go on to raise their next round. So I told you about that, the pass rate of the filters on funding. Look at the sheer non-linear degradation of value as companies go from one stage to the other. This is a brutal environment. And just because you raise your last round doesn't mean there's any guarantee of your next round. So always remember, you have to be on your A game 24/7. You will always be raising, and your last round is definitely not your last round. Next, when you're preparing for a raise, and most of you might be starting companies or planning to start somewhere soon, always remember that preparing for a raise is the academic exercise where you have to be intellectually honest with yourself and your team, right? So you have to be able to convince yourself and represent your business as clearly as possible. Now, if you are trying to fool yourself and you're trying to fool others, you will almost always miss reality, because then the layer of delusion that you're putting upon yourself is obviously a very clear disadvantage. So what do I mean? Let me give you a simple example. Timing in startups, everyone keeps talking about timing and being important and so on. Why is timing important? Because wherever you might be on a curve, the projection of where you will be is not based on your previous trajectory. So, machine learning is basically statistical projection based on a training set. Your lived experience up to today is not always an indicator of your possibly lived experience in the future. And that's why knowing today, knowing the parameters, knowing reality today as well as possible is the only way you will be able to figure out if timing is in your favor. Because unfortunately, no one can predict the future. So when you're timing your market, timing your business model, timing what is hot, what is not, all of that is part of the timing question. All that feeds into timing your raise. And there are some elements you have control over, but some elements you never have control over. And that's why, again, tautologies become unfortunate part of your planning. So for timing your raise, there are some things that are very clear. You should have at least 12 months of money in the bank before you plan your next raise. Of course, in the early stage, very hard to have 12 months of balance sheet cash, obviously, but this is the state you should try to get to. And you should remember that it takes anywhere between 6 and 9 months to close a round, even if you are able to get a term sheet. You also have to have a very clear view of the status of your product market fit. And if you do not have fit yet, but you're running out of money, you're on a shaky wicket. You're already becoming difficult as an investment for investors evaluating. The risk to execution. You have to be able to understand that I need money to build things, to hire people and build things. But if I don't raise money now, then how do I get to product market fit? How do I execute? I need to pay these people. Tautology. That's the answer you have to solve, right? And money is not the answer to that question. Money comes after you answer that question. So it's very important for you to know that money is not the answer to all these questions. The answer comes from your ability to pitch the business, the narrative you're building, and the tangible evidence you can give that you are the guys to build that company. And again, I'm sorry, I have to repeat this word again. I hate this word, but if your space is hot, if your space is not, unfortunately or fortunately, has a large role to play in whether you will be able to raise money when you hit the market. But of course, at the elemental level, investors are also not foolish. These are some of the smartest people you'll meet. They're also incredibly competitive. They have to compete with hundreds and thousands of other VC funds to raise their own funds every year. What are they looking for? They're looking for very simple things in the business. They're looking, of course, at your quality. We already spoke about that. They're judging you, your background, your narrative, your ability to communicate, your ability to sell a story, convince, and your ability to build credibility in their minds. But at the business level, they're looking at repeatability. Can we continue the business this way and make more money? Scalability. Is this truly a company that can scale non-linearly? And profitability. Do you understand what is going to lead to your company being profitable down the road? Doesn't matter if you're profitable now, it's the clarity of the profitability you can project that is very important. So that is what investors are looking for. We'll talk about this more and more. We have some examples, but just keep this in mind as you are thinking about not just yourself, but what are investors thinking about you. And finally, of course, when you're preparing for a raise, remember, you are pitching to an investor that is hoping you will raise a larger amount of money after they invest. So that's how you become a unicorn. From 10 million valuation to 1 billion, you have to keep raising money, like I showed you before, to keep getting your share price higher and higher, your market cap, your valuation higher and higher. That happens with every follow-on equity round. So you have to remember, you're not just raising one round, you're also trying to convince the investor you are the guy who will raise a bigger round next round. Because that's where his share price escalation comes from. So you are always thinking about two rounds together, this one and the next one. That's the way to make sure you can convince the investor that you are thinking like them. And both of you can be partner shareholders in making this company very valuable. I'll skip through a lot of these things because in the interest of time, I'd rather show you some of the visual examples. But when you're sizing your raise, should I raise 1 million, 500K, 250K, 750K, 2 million? How much do you raise in a seed round? There are no rules anymore for what is a good seed round, what is a bad seed round. There's money available. So again, it comes from knowing yourself. You have to figure out what kind of money your business needs, how much you can raise now, how much you can raise later, what valuation you should raise at now, what valuation you will raise later. And you will have to set very clear milestones in between the two rounds so that you can predict at what rate your company will grow and what rate it will have to raise again. So there's a very simple, straightforward calculation called the cash burn down. If you just Google it, you will find very clear explanations. Mark Suster is a great guy, terrific VC blogger. A lot of people explain how to think about sizing and approximating burn. So this is an important calculation you can do to test your ability, your specificity in how you will plan your raise. Of course, now on the narrative, it is very important you represent your business correctly. So, as you guys are looking at blogs and videos and so on, you would have seen people talk about moats, funnels, flywheels, all kind of analogies. It's very important that you look at it from a meta perspective. They are trying to abstract their business into a familiar model you want to understand. Right? For example, every SaaS company that sells software B2B, every SaaS company has to be able to explain their funnel. This is a typical SaaS funnel. Now, as an investor, we've done many SaaS companies. If we see a founder who knows the inside out of the funnel intuitively, we know, okay, this guy, I can ask very pointed questions and I will get an answer that I can evaluate. But if I have to coach you on what is a funnel, I'm wasting my time, you're wasting my time, you're wasting your time. So remember that you have to be able to represent your business correctly. And that's why studying the environment, how does my business model get spoken about, is really important. We use the word moats very often. What is a moat? A moat is a very business MBA style word in what is a structural advantage or a deterrence to competition. And there are many types of moats. This is a typical MBA textbook answer. I'm not an MBA, by the way, so that should tell you that how much respect I have for the field. But they get some things right. They try to structure things very interestingly. Again, there are 101 blogs written about moats. You should know it's important. You should be able to specifically state what moats you have right now, what moats you will build, and what moats you definitely need as your company gets bigger. Finally, in terms of timing, I explained burn down to you, I explained burn to you, I explained projecting how much time you will need to get to product market fit. Always remember, there's a time to invest, there's a time to conserve cash, and there's a time to, of course, invest even faster and grow aggressively. If you try to invest aggressively in the start, burn all your money before you have a repeatable, scalable business model, you will run out of money and no one will fund you after that. You will lose a lot of credibility, you will lose a reputation, you will lose other people's hard-earned capital, you will lose the entire value of your shareholding. But if you know that you have to conserve cash when you're finding product market fit, and then when everyone is convinced, all of you will feel it, you have hit something, you've hit gold, that's when you have to invest aggressively, raise money, and take over the market. So when to grow versus when to conserve is a very important dynamic. As a founder, you have to have the intellectual honesty to be able to make that decision. And of course, everyone's favorite topic is valuation. Now, I don't know how much of you know who Vince McMahon is, but I think WWE makes the story of money almost the kind of circus that it actually is. Everyone thinks money works a certain way, valuation grows a certain way, but the honest answer is valuation does not grow linearly. I hope I've given you enough evidence on previous slides to show you that you're constantly being judged and evaluated and you're jumping from milestone to milestone. And it's very important that you understand which milestones you're setting for yourself, which milestones you've already achieved, which milestones you're dangerously far away from achieving. All of these things being sequenced the right way when you're starting out will be an incredible advantage you have once you actually start. So please remember that there is no fixed answer to your milestones, but there definitely is a great way for you to plan your staging out so that you know when you need to raise and how you need to plan far ahead of time. So do we know what problem we are solving is the first milestone. Does it actually work? People pay for it. Does it actually work? Meaning the solution solves the problem. That's the next milestone. Now, will someone pay for it? Will they actually buy my solution? That's the next problem. How many people will pay for it? Only 10,000 or maybe thousands, millions? That's another answer. So every milestone that you answer will lead to stronger and stronger belief and credibility in your model and your ability to, of course, execute. And finally, look, let's be very honest. Sometimes, rarely, money will come to you when you didn't want it, expect it, or need it. Always take the money. You never know what the future is going to be like. You never know when wave 3 is coming, next big crash, next big financial crisis, some big politician dies, a new party comes to power. You have no control over the macro, but you have to understand that when options come to you and something's available, if it is capital, if it's coming at a fair price, take it. Because having a balance sheet, like I told you, capital as a moat, if you remember on a previous slide, that is always a valuable position to be in. Finally, very quickly on the pitch, this is where I'll go the fastest. I have no interest as an investor in the sequence of your pitch. Enough and more blogs have been written about what comes first and what comes next and which photo has to be where and which graph and so on and so forth. Y Combinator, Sequoia, all of them have written blogs. Find something that makes sense, understand it, use it. These templates are just standard operating procedure. There is no innovation on the template anymore. What is innovating is your business, your vision, your story, your milestones, your narrative on top of what you built. That is the innovation. So don't overthink the pitch. Don't overthink the pitch deck. Just make sure it's of standard quality, well designed, clean fonts, no spelling mistakes. Obviously, you want to make sure you leave a good impression. Know the heuristics. When you're going into a pitch, like I said, know yourself, know your market, know your competition. But also, I showed you the funnel as an example. Know all the heuristics that are used in your industry. If you're starting a SaaS company, for example, there's something called the rule of 40. I didn't know this until I joined my first company and it was a SaaS model right after college, right? So in hindsight, I would have been a horrible founder because I didn't know it. I had to learn it on the job. So it's very important that you know the heuristics of your market before you go out to the market to raise. Because investors will be judging your know-how, your knowledge by throwing questions about the heuristics. So what is your rule of 40 projection? What is your conversion? What is your DAU growth? What is your NRR? You won't even sometimes know what NRR is, but you have to know these heuristics before you go and pitch. And finally, of course, please remember all the investors, angels, your professors in your incubators, everyone is human. And they all have very basic human faults. The attention span is a non-linearly degrading function of time. So remember, your first couple of minutes is where you have everyone's attention. Grab it. Speak clearly, start with a story, whatever it takes. Show the best numbers of your company, throw a big problem on the screen, whatever it takes to make sure that as far as the rest of the pitch is concerned, you are able to hold everyone's attention for as long as possible. So gaming the audience, keeping them engaged is very definitely something that you cannot skip out on. And finally, like I said before, you will always be raising because you will always have milestones to hit. You are never done growing the value of your company. But remember, what is the end state? I mentioned this before. The end state of your company is very simple, to be a cash generating machine. Byju today is growing 2x revenue every year, 200% growth every year. 2 years back, he made 100 million in revenue. Next year, 200 million. Next year, 400 million. This year, he made $1 billion in revenue. He is growing consistently every year and becoming a cash generating machine. And if you're able to do that in a repeatable, scalable, profitable way, that's it. That's your end state. What technology, what fonts, what colors, what front end, all of that is a backfilled answer to becoming the cash generating machine. So in your head as a founder, have clarity that this is the end state I have to build to, no matter what sector I am in. Food delivery, to SaaS, to fintech, to edtech, CGM. Keep that in mind. Of course, fundraising isn't fair. So if you think that, I didn't raise because, he's IIT Bombay, I am IIT Guwahati, or he is Stanford, I'm not Stanford, doesn't matter, right? You do not control what is hot, you do not control what is not. There is no big, government regulator dictating what is fair, what is not, who can raise, who is not. Just remember, once you are a founder, you are facing brutal global competition. And there's nothing called fair. It is only about the survival of the fittest. And that's why when people like Thiel, for example, one of the more interesting founders, investors now, when he writes things like this, that happening companies are all different. Each one is a monopoly, solving a unique problem, and all failed companies are the same. They all fail to escape competition. This is why things are not fair, because you never know what your competition will do to beat you at your own game. And this is why after all of this, when you do this curve, and I know I was fortunate to be on campus at Stanford when he taught CS183. We saw this in person when he was drawing this out on the board. Most people think that venture is a linear business. Your best company will be 10x in value. Your worst company will be, somewhere 1.5x. But actually, in reality, your top 2, 3 companies will be some silly 10x, 20x, 100x type companies. But after number 4, all of them will fail or lose money. And if you think this Pareto distribution, this hyperbolic rectangular hyperbola, if you think it looks a little too engineered and maybe it's not real, these guys don't know what they're talking about. This is a distribution of n number of dice throws and the average win frequency. It is eerily similar to the non-rectangular hyperbola you're seeing here. So what I'm trying to say is, whether we think it's fair or not, whether we think it's competitive or not, whether we think there's a right way to do it, wrong way to do it, in the end, when you blow up the projections and the probabilities and you try to pitch a gambling situation with actual hardworking startup founders trying to make value, in the end, the distribution is remarkably similar. In fact, it's almost like the universe is playing a very cruel joke on us, telling us that none of this matters. So, am I trying to dissuade you? No. What I'm trying to say is, in some degree or the other, if you want to be a startup founder, there's no shortcut to saying it. You have to be a little insane. These are the riskiest types of companies to start. These are the riskiest sectors to be in. You're betting your entire life on it. If you're a founder, you're hiring employees, you're betting tens, hundreds, thousands of people's careers on this. At some degree, you have to be a little bit of a crazy guy to be doing all of this and expecting new results every day. So, tautology, remember that, but that is a reality. And if you do it right, if you're able to keep a clear head, remember, in the end, I showed you all those billion-dollar outcomes. That is why you're doing it. If you're attempting this, you are attempting this to be an outlier. You are not the average. You are not aiming for a mediocre outcome. This is not your, I couldn't find a job, let me start a company. This is your life. And if you're committing to be a founder, you're committing to create jobs, employ people, raise money, work with shareholders, you are committing to be an outlier. And that's why I must say, after all this, it's not easy. It's certainly very competitive. Nothing is fair. But if you're able to make it through, you will build something that stands out in your entire generation. And generations of people will remember what you did. So remember the gravity of what you're taking on. Remember the quality of the person you have to be. And very importantly, remember the effect you will have when you succeed on the country, on your society, on your family, on your employees, their families, on the rest of the world. This is a unique position for us to be in. It's a privilege to be a founder. It's a privilege to be an investor. If we embrace our roles and we do this right, I'm very clear we will build a country like our parents, our grandparents did not imagine we would have by the time we are their age. And with that, I have finished all my slides. Thank you very much, guys. I'm happy to answer questions if you have any.
So now we are open to Q&A session. So the first question is, which sectors you think will be hot for investment in next 5 years?
Good question. So I can show you what has been historically attractive. I would say the three standouts are e-commerce, fintech, and consumer. And of course, these are broad sectors, but the India opportunity is thought of as having very large total addressable markets in these three areas. So I can argue today the e-commerce wave is more or less done because Flipkart's a big winner. The other companies have not been very big winners. Amazon has become huge. Jio is starting out now. Tata is starting out now. So the typical e-commerce marketplace, that story may be over. But for example, vertical e-commerce, B2B e-commerce, export import e-commerce. There are many subsectors of e-commerce opening up that will be the next big areas that need to have large technology solutions built. So you will see sub-segmental sectors of hotness, quote unquote, of interest. And that's why I think don't base the pattern of what is going to be hot in the future just on what was hot before. It will be a large striation, a lot of deviation from what we have seen so far.
So, second question is from Mayank. Since you have been a part of Stanford, how is the startup culture of India different from that of Silicon Valley? Could you tell us about the difference in the investor's perspective today?
Of course. So I mean, I'll be very transparent with you guys. When I was in school, I had to make a decision: do I do my undergrad here, write the JEE, so on and so forth, or do I just say I want to go to the very best that I can and work backwards from that? Thankfully, I could decide, and my parents were okay that don't write JEE, don't do the competitive exams in India. Just try to get into the best college in Bangalore. Bangalore is a good place for engineering, and then work towards an advanced degree outside. So that's what I did, and I'm happy to say that I was able to get the best of Bangalore and, of course, Stanford, great place to be. Over that 4+4 years, I will say that there are three big differences between India and the US. And unfortunately, I think these differences will be something you experience also, even though I'm almost 10 years your senior. Number one, in the US, the university treats you, the student, as a customer. The university has to give you a great experience, great quality professors, great quality campus, fantastic food, all the amenities, football, swimming, everything. Fantastic accelerator. Call Peter Thiel, Mark Zuckerberg. The best people have to come here and talk to our students because our students deserve the best. In India, unfortunately, like I briefly mentioned, we have a very top-down command and control, unfortunately, socialistic setup where students are the fodder for the machine. We are the input. And our, tied up, press shirt, industrial style, employee readiness is the output. Our universities do not treat us as customers. We are treated as products for employers. So a big difference is, unfortunately, as students, we do not have the flexibility, the freedom to have self-determination in what we study. I am an electrical engineering student. I did electronics in undergrad, electrical engineering masters. I could take courses in the MBA program, in design, in computer science, in statistical computation, in machine learning, even computational biology. You guys, IIT, you guys are the best universities in the country. Even that after first year, that fight to get the change of department, you've seen it becomes even more competitive than your entry into IIT. We are made to choose a department when we don't even know what engineering is. So there are unfortunately structural disadvantages we have as students in India. And I think the system is very unfair to us. So we can complain about it, or we can say that is reality. Let us focus on being the best product we want to be for ourselves. Forget the system. Let us, do the system, write the exams, whatever it is, that's fine. But once we are out, ask us, did we learn enough? Do I need to take this class? Can I take another program? Can I take something on Coursera or Udacity? Or can I take some digital program, get a digital certificate? Maybe I write the GRE, I try to get into a campus. You have to take control over your own life. I think that's the number one lesson I learned when I went to Stanford. So unfortunately, we are treated badly as students in India, but that I hope is not going to hold us back forever. In fact, I'm very happy to say some of the best people I met in Stanford were IITians. And I can tell you all of them told me that we just made it through. We didn't trust the system fully. We took agency control into our own hands, and we are here. We are wherever we are, Stanford, Harvard. We got a job straight in Google, Facebook, whatever. We will now work for ourselves, and we will make it happen. So yes, we have some disadvantages. I think it will take some time to change. Hopefully, NEP and so on, hopefully makes it better for us. Hopefully, the number one rule I hope they break is that they don't make IITians choose a department when they're entering. Just get into IIT, get into a campus, and open it up, take courses, pick a major. The US system is very good to build more rounded people. So I hope we get there, but that I think is the largest difference. And of course, I hope as IITians you will study more, you will work in startups, you will spend more time finishing yourselves before you start a company. You have the full opportunity available in front of you.
Third question is from Chetan. Which thing matters most for judging a startup for investment? Like, is it idea or business model or market?
Good question. Many different investors have different priorities for those three. So I'll say the four important things are market, product, team, and timing. Those are the four things, parameters that you have to stack rank. Some investors are very market focused. They are market specialists. So, for example, you have fintech only investors in the US. Ribbit is a good example. Ribbit is a top tier fintech specialist VC fund. In India, you have Fireside, for example, which is a consumer focused fund, only consumer businesses, brands, and so on and so forth. So, most investors have different priorities for these four. There are some investors who go market, product, then team, and of course timing. Or other investors are more opportunistic. They say timing. First is timing. We are that way. We say timing. So what is the right time? Which market is the right time right now? Then team. And then of course, because we are early stage, there's almost always no product. We work with a team to build the right product. So different investors have different approaches. But I would say for sure, what you can't negotiate with is a bad market and bad timing. If they are wrong there, no matter how hard you try, even the best team you could have. But if you're writing the best Python compiler in 2021, I'm sorry to say it's a solved problem. Doesn't matter anymore. Focus on something else. So timing and market have to be, in my opinion, always right from a founder's perspective.
Fourth question is from Harish. This is a very good session, sir. How do I survive as a company if I'm from a not so privileged background and VCs won't fund startups to pay founders' salaries?
Fair question. Look, again, we spoke a lot about knowing reality. Again, the world is dominated by human beings, and human beings pick artificial labels as a measure of credibility. So if I'm assuming you're an IITian student, I promise you are much more privileged than all of my batchmates from RV College in Bangalore. There's a tremendous positive bias towards IITians versus non-IITians, that you know, right? But also inside IITians, you guys know, IIT X is more than IIT Y, IIT Z is more important than IIT Q. There's an inter-IIT bias also, okay? And then there's a department, then there's a dormitory, then there's a, did you go to Stanford or did you go to LSE or did you go to something in Singapore? There's always NUS, there's always ways in which people will try to filter out other people and assign credibility based on a label. I'm very happy to say that you guys, particularly whoever asked the question, you're already off to a good start. IITG, very respected. You have much, much more advantage compared to most Indians in your cohort, right? Now think very carefully about what are the demonstrable skills and labels I need to get me to where I am. So for example, you might say, okay, IITG not good enough. Maybe I should go do a master's. Or maybe I should work for Baiju before I start an edtech company. Because then I'll have more credibility that I worked in Baiju, I saw the edtech market, I worked for the market leader, and then I left and started a company, right? So there are many ways for you to be able to signal to the market that you have consistently invested in building your credibility and your market worthiness. You're not required to start a company right out of IIT. Remember that. So be very careful and think 5-10 years out and work backwards on that to figure out what you need to do to get there. So I know it sounds a little bit loose, but that is exactly what worked for me. And that's exactly what worked for the people I look up to, my seniors, my batchmates. Almost everyone I know has done it that way.
Fifth question is from Prithviraj. Which sector you are interested the most when it comes to investing in it?
Great question. So we've had very good luck with EdTech thanks to our exposure to Baiju. So today, EdTech for us, we've seen the big company. Now we want to see if there's something else we can build. So we're always interested. FinTech has done very well for us. I must say, we've been fortunate again to be in the category creators of neobanking and so on. If you go to our website, you'll see our FinTech companies. And we've done very well in consumer. So thankfully, some of our consumer companies are now category creators, large companies like Licious. So these are the three areas where we have been historically consistently beating our own expectations of returns. So those are the three areas where we are very positively biased.
Sixth question is from Abhishek. Which one is non-negotiable according to an investor team, market or idea?
Market. The idea can always change. You can always sub-segment your product, sell to different stakeholders, pivot if you have to. But if you're starting off in a losing market, it's not negotiable. If the investor says, I don't like this market, here are my reasons why, and you're not able to debate, you're not getting the money. So I think market is the inflexible component of your startup. But your idea, you can always have different dimensions, extensions, pivots. The idea can always mutate. And always remember, one another very important but unfair truth of reality is that almost no idea is unique or new. Most ideas are stale, old, repeat mutants of previous ideas.
Seventh question is from Sai. Does the investors get return also in that amount?
Sorry, I didn't understand the question.
Does the investors get return also in that amount?
Return. Sorry, I didn't understand the question.
We can move to the next question.
Yeah, we'll move to the next question.
So the eighth question is from Himachal. As a student, how do I prepare myself to take big risks as someone who doesn't feel comfortable to do so?
Great question. The first thing is understanding you're taking a big risk. Most students don't understand that if they're starting a company in third year, fourth year, let's do it, let's get together. This social guy did it, why can't I do it? Unfortunately, the world is not a movie, and you are betting your entire life on that company that you're starting right now. So if you are thinking about the projection of your career, your life, what is important to you, if you're starting a company, you have to be very sure that even if you get no salary for 3 years, 4 years, sometimes you're okay. Even if you get, for example, 1 or 2 years of very difficult product market fit journey before you hit fit, that's okay. You're okay with that. You can't keep assuming you'll be in the best case scenario all the time. And that's why if you look at the average age of successful founders, the average age is 35, 37 in India roughly for the best founders. What they've all done, most of them, is that they've spent a decade building a career, getting experience, building their own balance sheet, making good salaries, stability in their family. You may have obligations to your parents, your extended family, so on and so forth. Once you have security there, that is when you can take large risks like starting a company. And if you are young and you say, okay, I don't have all these things right now, I have 4 years where I can take risks. A great way to proxy risk is join a startup. You don't have to start one. Join a startup, a young company, maybe seed round startup, maybe Series A startup. Think about the experience you want before you start a company. Because like many people say, right, Himanchal, if I'm getting your name right, many people will write blogs and put videos, and I'm sure they've come and given you lectures that failure is fine, failure is standard, it's okay, be comfortable with failure. I don't agree. I hate failure. I don't want to be wrong. I don't want to fail. Why do I want to fail? My time is very valuable. I get one life. I don't want to fail at anything I do. So as a student, you should be very clear. Do you want to fail, or are you acceptable when you fail? I don't think so. Most people are not. So game it out. Take a game theoretic approach to the 10 years, 7 years, 5 years, 3 years, 1 year. Carve out your time schedule and sequence your experience. and keep in mind that you're building towards some scenarios that are important to you. So if you're adamant you want to start a company and you want to be a founder of a unicorn, okay, then that's fantastic, that's fine, that's your end state. Figure out what experiences you need to make sure when you do start your company, you have the highest chance to succeed. So that's how you game out the risk. And again, Swadhyatma, the answer will come from you.
So, since we do not have any more questions, this brings us to the end of this session. Thank you, sir.
Thank you,
And
Nidhi.
on behalf of ESL IIT Guwahati, I'd like to thank you for taking out some time from your busy schedule and enlightening us. Also, I would like to extend my thanks to all the countless people associated with this event. Without their hard work and dedication, it wouldn't have been possible to conduct this event so successfully. This is the end of this episode, but not this event. So stay tuned for the upcoming episode of Startup Odyssey on 4th July.
Thank you, everyone.